Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Jim Welsh from Macro Tides. He's with us once again. Good to see you, Jim, and glad you can make it here to the Trader Summit.
Me too. It's always great to talk to you, Blake, even if it's on a Thursday.
Yeah, we're doing it a day early. I know you have some you have something you have to be attending to tomorrow, so we wanted to make sure that we got this video in this week, and all of us really appreciate that you are here today. To kind of explain to us, well, let's talk about some of the action this week. CPI, stocks ripped, dollar crushed, and I mean CPI barely even missed, and it's still above 4%.
Well, in the Monday weekly technical review, I went through and I said, okay, I think the headline is going to drop from 3.7 to 3.5. The core is going to drop from 4.1 to 4. The headline dropped a little bit more. There was more weakness in some categories, and it went down to 3.2 due to rounding. So I expected Wall Street to overreact, but I never expected the degree of overreaction that happened. And the conclusion that Wall Street seems to have drawn is that, okay, with the CPI coming down like this, the Fed won't be raising rates. So, that 25 basis point hike is off the table. Whew, thank God. It's almost as if not having that next 25 basis point increase is more important than the 500 basis points they've already increased. All right. But more importantly, Wall Street now is thinking that the Fed will be cutting rates on early next year. So the probability for a cut in March is 25%. A cut in May is 65%. And they're like between 3 and 4 cuts for all of next year. And it just doesn't compute, Blake.
It doesn't. It's so, I mean, Mark Chandler of Bannockburn, he's written a lot of great books about currencies. He's been somebody I've followed for a couple decades on CNBC, and just a really overall great guy that I interview here quite a bit. He said it perfectly. Is like the pendulum swung way too far, and but that's the markets for you, right? They will exaggerate.
Well, Wall Street's done that consistently over the last year and a half. I mean, remember, as inflation started to come down, immediately, it peaked in June of last year. So it's coming down. Wall Street's, the Fed won't have to be as aggressive. Well, then the Fed raised the funds rate 75 basis points in July, September, and November. So they were dead wrong about that. And I think they're going to be dead wrong about this too, because Wall Street is acting as if the only thing that's important to the Fed is inflation. Nothing else is entering into how they conduct monetary policy. And as you and I have talked for quite a while, I think Powell has signaled that for he and for the other members of the FOMC to have real confidence that, okay, inflation trends down towards 2%. But importantly, they want to believe that it will stay near 2% after they cut rates and at the beginning of the next expansion. And the only way that happens is, and Powell again has said this, we avoid the mistakes of the 1970s. And he has said easing prematurely would be a mistake. And so as you and I have talked, the things I've focused on are excess capacity throughout the economy. And we're going to look at a couple of charts in terms of capacity utilization and unemployment rate for the labor market. And so for me, the Fed wants the economy to slow below its long-term trend, which is 1.8% for the Fed. So from the Fed's way of approach is above 1.8% is still adding some inflation pressure. Below 1.8% means you start to dissolve and remove inflation pressures. And it's going to take a long time. He has said that repeatedly. It's going to take an extended period of time. We haven't had a single quarter in the last 5 quarters below 1.8%.
Yeah.
And, they projected unemployment at 4.1. It's at 3.9. In order to have the faith that the labor market isn't going to tighten quickly after they cut rates and then lead to wage increases, they want to see enough slack develop in the labor market so that isn't going to happen. So to me, Wall Street's fixation on inflation was understandable a year ago because it was obviously a 40-year high. But to assume that is the only thing the Fed is using to guide policy at this point, I think is a big mistake. And therefore, Wall Street's setting itself up for being disappointed, because the only way the Fed's going to be cutting rates in March or May is if the economy is way weaker. And
Yeah,
I
was going to say it. We've got to see some horrendous data. And this is a conversation I had last night with Chris Weston of Pepperstone. It's like the data's got to be absolutely horrendous for the Fed to start cutting rates. But hey, you got a lot of chart, Jim. Thank you for the explanation. And we can start off because this is your first chart is regarding CPI.
Yeah,
and I guess we should probably just start there. And I mean, it's still above, as you point out here, it's above its the 2% target, right?
Yeah, well, the core rate, the Fed is not going to pay that much attention to the headline because of food and energy and so forth, and they're very volatile, but it looks at the core, it's at 4%. It's double what they want to see. Now, no question that the trend is down, and it's going to continue to work its way lower. But as I said, inflation all by itself in a vacuum isn't the only thing guiding monetary policy going forward. So this is just to point out that, hey, it's nowhere near the Fed's target. So it's going to have to be comfortably under 3% before the Fed is going to think, okay, we've really made, we got significant progress behind us, and now we're actually getting that last mile that we need to see to really believe that inflation is going to stay down early in the next expansion.
But let me ask you this then. What makes you say 3%? Because it's obviously still above the Fed's target, but I know it's trending lower. But if they start cutting rates, aren't they just going to do it prematurely? I mean, this is what.
Well, again, that's why I think the Fed is going to be slow to cut rates. I'm just saying in terms of a checkbox. Core CPI, core PCE, which is even more important than core CPI, being under 3%, trending down. Okay, now we want to see, is GDP been growing under 1.8%? How many quarters has that been happening? Where's the unemployment rate? So it's the whole package that the Fed needs to see to have confidence that, all right, it's time for us to cut. And based on Powell's comments, I think they're going to, maybe wait a month or two beyond what Wall Street will expect for them to cut. And that's why I think that's where the period of vulnerability happens for stocks, is we're going to get data and all of a sudden people are like, whoa, maybe we are headed toward a recession. And yet the Fed isn't going to give any signal that they're cutting rates in the near term. And I think that's where the stock market is most vulnerable to a 10 to 15% decline in 3 weeks. And that's the kind of, I think, potential outcome that we'll see sometime in the first half of next year.
Well, the next chart you brought for us, is capacity utilization. So let's take a look at this. And why are you bringing this chart to the table?
Well, the reason is manufacturing capacity and production capacity obviously is one of the components in terms of how tight the economy is. And there's been a long-term gradual downtrend. In other words, like 30 years ago, 85% would be where capacity utilization would get to. So the point being is, when you look at recessions, we can see that capacity utilization, that second line from the top, horizontal line, is 75%. We're at 79.7. So we're almost at the 80 mark, which is the first horizontal line. And I just think, to me, if I'm on the Fed, I got to see that thing drop and ideally get near 76% or below. And the only way that happens is if you get a recession or a very significant slowdown in the economy. And so to me, this is one of the key points that for us to be gauging, okay, when will the Fed really seriously consider cutting rates, is when we see more slack developing in capacity utilization.
Really great chart, Jim. I appreciate it. And I'm sure everybody appreciates it. The next chart that you're bringing here is the unemployment rate. And what does this tell you?
Well, it basically, again, you go back, this chart goes back to what, 1965 or something? I don't know, 60.
Yeah.
And, what you can say is the amount of time below 5% has been somewhat rare over the last 6-7 decades. We're at 3.9%. We're just a handful of months off the 50-year low of 3.5%. So again, we're starting to see it curl up. But I think it's going to go comfortably above 4.1%, which is what the Fed has targeted. Whether it gets to 5%, I have no idea. You never know. Once the economy slows down, things happen. So already we're seeing, we showed a chart last week, corporate bankruptcies in the first 10 months of this year are the highest through October since 2010. We're seeing credit card default rates, auto loan default rates, not just creeping higher, they're impulsively moving higher. So here we've had an economy that's been growing almost 3% for the balance of this year. And we're seeing these signs of weakness showing up under the surface. And I'll mention another one, the unemployment claims in September, continuing claims were 1.65 million. Now they're 1.86 million. That's a gain of 200,000 in 2 weeks. And the reason why that's significant, Blake, is a year ago, somebody lost their job. They were able to find a new job very quickly. So one of the signs that the economy is slowing, somebody loses their job and it takes them longer and longer to find the next job. And as a result, as more people start to get laid off and it takes everybody longer, continuing claims move up. So to me, we're going to see the unemployment rate tick higher in the first half of next year. And as the economy slows, weekends are already showing signs of stress. As the economy slows, more and more people and companies, small businesses will be pushed kind of towards the edge and they'll cut back. So again, the signs underneath the surface are, I think, beginning to accumulate. And we've been talking about this for months, that these were the types of things I expected to see in the fourth quarter, and they're starting to appear.
And 4 or 5% unemployment. I mean, it's not. I mean, you're talking about. I'm just visually giving you that look here. But if you go pre-financial crisis, this is the GFC that you can see right here. Pre-GFC, you take the last few the few decades, or a couple of decades before that, into the late 80s. I mean, we had unemployment at 5%, at 7%. I mean, it's not like abnormal. I mean, I know a lot of young Wall Street folk that are watching this video right now are like, well, I've never experienced anything like that. And yet COVID doesn't count. I'm sorry. It just
no. COVID. I wish they didn't have, or they clipped that spike. Right. So you could see the breadth of these other prior moves, I think, in better proportion, but it is what it is.
Yeah.
Again, the bottom line here is things are heading in the direction for an increased slowdown in the economy at a time when Wall Street is more certain than ever we're not going to have a recession. It's kind of like all of a sudden you look down and your pants are around your ankles. That's the moment that's coming, I think, for a lot of people who they were in the recession camp a year ago, and now after a 4.9% GDP print for the third quarter, there's no way we're going to have a recession. And I just think that that's classic setting up psychology for another surprise.
Well, let's hope the water isn't too cold, right, Jim?
Yeah, you don't want to have too much shrinkage.
Right, exactly. All right, so
an old reference to a Seinfeld episode from years ago.
Hey, you guys tune in not only for the great information, but also the jokes. And if you love them, make sure you give Jim a big thumbs up and subscribe to this channel. Okay, NFIB small business sales. Tell us about this.
Well, again, what happens in the real world is the Fed starts to raise rates, then the banks start to increase lending standards, which means they lend less money to small and medium-sized businesses who rely almost exclusively on bank lending. And, it happens like a curve where, if you took out your last loan in July of last year, okay, now it comes due. Whoa, That's a big increase in your cost, and your credit line may have shrunk from $1 million to 750. So what this shows is small businesses, as measured by the National Federation of Independent Businesses, what's their outlook? Well, you can see it's pretty tepid and looking not good. So if I have that outlook in terms of, I think my sales are going to get weaker, and they actually do start to get weaker, then I'm at some point in time forced to, I don't want to lay anybody off. I've already cut back hours. I've gotten rid of overtime. If I had some temporary workers, I got rid of those. Now I'm finally, with sales weakening, I'm at a point where I'm going to have to let somebody go. And that's why, employment is a lagging indicator, because it's a reactive function by businesses to a shrinkage or slowdown in revenue growth relative to their costs. Yeah. And it's coming.
All right. Well, let's okay. So I'm gonna take a step back, talk about the reaction of the markets this week. The first chart you brought for us here is the dollar. The dollar just absolutely got smashed following CPI. Yep. I actually just personally blogged on this a few minutes ago. What are you looking at here?
Well, the reaction to the CPI has kind of forced me to say, whoa, wait a second, maybe something else is going on here. As you can see by those alphabet letters, A, B, C, and as we talked last week, it's kind of like, okay, I think we've completed an ABC, and we're on our way up to 107.34 or higher. The dollar lost over 1.5% in reaction to the CPI report. And all of a sudden, it's like, okay, the bigger picture view that we've been talking about the last few weeks is, we get this move over 107.34, and then I think as the economy weakens next year, we're going to see the dollar drop below 100. Well, it's possible, given what we saw happen in response to the CPI report, Blake, that we're not going to see that move above 107.34, and we're going to see the dollar work its way down, ultimately in the first half of next year to under the 100 level. In other words, going back to the lows of last July. So, I think that response to the CPI report is confirming my view that, all right, when the economy really shows signs of slowing, the dollar is going to weaken, because the drop in the CPI report, convinced people, oh my God, the Fed's going to start cutting rates. Well, a slowdown in the economy is not going to be beneficial for the dollar. And, the dollar has benefited over the last 2 years on balance from the U.S. economy doing better than Europe and a lot of other countries. When that changes, I think people are going to sell the dollar. So, okay. I'm less bullish about the dollar.
my expectations of the dollar going to 120 is not happening, you're saying?
Not anytime soon.
All right. Well, boo-hoo on you. I'm going to continue. So the next chart you brought is gold. Tell us what's going to happen here in gold then. That must be new highs in the gold market, right?
Yeah. I mean, basically, I thought if the dollar was going to make this move above 107.34, we would likely see the gold drop below the low it made about a week ago at 1931. I think, again, the pattern has been is like, okay, we had this shot up from the low in October. We're getting a little bit of a pullback, and then we're going to see a move that takes gold, again, to, I think, all-time highs in the first half of next year. And it may be accelerated in the sense we're starting to see that already begin with the dollar weakness. So on Monday's report, I had recommended gold, and then I had a stop and got triggered. And then on Monday, I said, buy it on the opening on Tuesday, because I don't want to miss the move. You don't want to miss
this move. Yeah.
Right. And also adding, the instructions were to add if it got above a certain level, which got triggered today. Because again, it's possible we've had one of three up. The little pullback was 2 or 3, and now we're really going to, move up aggressively. And I, with my longer term bullish outlook, I just didn't want to head fake myself out of the position.
All right. Well, appreciate you updating on us on that. TLT, I mean, how do you feel about the bond market? It's trying to recover. Can we actually
Yeah.
break out? The one thing I want to point out, just so everybody knows this, that I mean, the TLT is basically it's modeled after the 10-year, right? The
No, it's
10-year.
actually more like the 30 because the average maturity of TLT, Blake, is about 27 years.
Oh, okay. So then,
Yeah, so it's tied more to the 30 than the
got it.
10.
Okay. Well, then
Okay.
I stand corrected. Forget what I was saying. Continue on.
Well, again, a month or so ago, I was talking about, hey, we got 5 down from March of 2020. That means we're going to have a retracement rally, potentially pretty significant. But then you always need additional proof. And you can see you got 5 waves up on TLT. So that to me suggests that we're going higher. Irrespective of any pullbacks we see, we're going to see TLT move higher. And, some of the targets can be 105 to 1. I mean, TLT went from almost 180 to 82. So, a 238 retracement is, like 20 plus points. So that's where I get the 105. The 382 retracement is up near 119. So the high of wave 4 of lesser degree was around 109. So that's where I'm getting the 105, 109 is a very small retracement, the 0.238, and the wave 4 of lesser degree. So again, this is tying in with my view that we're going to see a significant slowdown in the economy, which means we're going to see insurance companies, pension funds jump to buy treasury bonds to lock in the higher yields.
Yeah.
Because, for a long time, they were starved for yield. So once they're certain that, oh, wait a second, the idea of the Fed cutting rates is somewhat realistic, and that will take slowing, evidence that the economy indeed is slowing materially. I think that's going to happen. The chart of TLT is, again, combining technical analysis with fundamental analysis. TLT, with that 5 waves down, was implying we're going to have a significant rally. Well, what's going to cause that in the face of a lot of supply? Well, the only thing that can happen is economic weakness. So there you go.
That makes sense. Okay. Well, Russell 2000 long been underperforming the rest of the markets. What's caught your eye here?
Well, again, as I noted back on when we talked October 27th, so you got 5 down from the high of late July. That means we're going to get a retracement rally. And I thought things like the equal weight S&P could get to 146. It got up to 146 and a quarter. 1800 would have been a target for the Russell. And obviously we got a little bit more than that. But you can see it's a clear A, B, C, up 3 waves. So if TLT, or pardon me, the Russell 2000 overlaps 1770, and I think it's getting close. I don't have I can't look at a quote stream right this minute. Then that confirms 3 waves up. So that leaves 2 options. Either we're about to get smashed, or that 3 waves up is wave A, and we're going to get a significant pullback for a B, and then there's going to be another leg higher for a wave C. I'm giving the latter more leeway from a standpoint of if Treasury yields come down, the Magnificent Seven are still going to show some strength. Oh, by the way, look at the high back in late July was 2004. They got to 1830. So it missed it by almost 175 points. What's that, 9%? Something? I mean, a huge miss. The Qs missed making a higher high relative to their high in July by 30 cents yesterday.
Yeah.
So the range of underperformance versus the Qs is huge. I think the Qs are likely going to rally to a new all-time high based on the decline in rates and so forth. So, to me, the Russell has been so clear in its pattern that I think it really pays to, continue to pay attention to it. It tipped us off to us, looking for the S&P to rally to 43.55 on October 17th or 27th at a minimum. And, so looking at various market averages sometimes can really help than just only focusing on the S&P or even the Qs, particularly when you're seeing such wide disparity in performance. You have to look at the whole picture.
Right. Well, the last chart you brought for us is going to be the S&P. So what's this all mean for the broader markets, Jim?
Well, again, the S&P doesn't have a clear 5 down because wave 4 overlapped the low at 43.13. But there's a thing called a leading diagonal. So, I mean, there's other weird things that you can get into. But from the lows of October 27th, you got 3 waves up here too. But as I said, I think if I'm right about treasury yields on balance working their way lower, seasonal positives over the next handful of weeks, I think we get a pullback, and then we're going to see another push above the high we saw at 45.21. One of the keys, Blake, is going to be the degree that we see the slowing in the economy appear in the next handful of weeks. In other words, if we get data that still is like okay, that supports the idea that Wall Street has soft landing. The slowing is perfect. Earnings are still going to be up and so forth. If we see much more pronounced slowdown in the next 4 to 6 weeks, that will raise a problem. I think we're going to see enough slowing that Wall Street will say, okay, it's not too much and it's bullish. Yeah. So again, the main thing is the first half of next year, if I'm right about the economy slowing significantly, they're going to have to readjust their outlook for earnings. And I think the S&P has the potential of trading down to 3,500 in the first half of next year. Historically, people don't realize this. When the Fed cuts rates, it's because the economy is in a recession. Yeah. It's not good for earnings. And if I'm right about the technology stocks being vulnerable as their customers cut back on capital spending and so forth, all of a sudden their revenue growth, which has been at 25%, slows to 15%. Hey, it's still great relative to everybody else. But that slowdown will mean those stocks deserve a lower multiple. And given that those 7 stocks are 29% of the S&P, and can the Russell take leadership if we're going into a recession or, the economy showing signs of slowing? I don't think so. So all I'm looking for is confidence that this rebound that was expected is over. And again, I'm giving the upside a benefit of the doubt.
Yeah.
But the chart patterns continue to reaffirm you had 5 down and most of the averages to that October 27th low. That tells me the major trend is down. Now we're just looking for a retracement rally. The pattern in the Qs is different. It's been much stronger. It didn't decline as much. So it has a shot for new all-time highs. And as I said earlier, it missed by 30 cents. So the patterns are different, but what that, in my take, is the Qs go to a new all-time high and all the other averages don't. That's a big red flag. So I just think people have to be very attentive and cautious that this rally is kind of like the last hurrah.
Yeah, and it's on fragile footing, isn't it? Well, Jim,
I think so.
I want to say we appreciate you spending your time with us this week. Next week is the U.S. Thanksgiving holiday, so we probably will not be meeting. So therefore, 2 weeks from now, I really look forward to seeing you, and hopefully the world's still intact, right? And we're seeing new highs in the NASDAQ. Let's just hope for that.
I think so. But let's wish everyone who's faithful viewers happy Thanksgiving. For those of you that are in the United States, happy Turkey Day. And same to you, Blake. Hope it's spent with your family. And we'll be back in 2 weeks, if not next Friday, depending on how the world goes.
100%. And thank you, Jim, for spending your time with us. I am thankful for you and our viewers. And I'm so thankful. And if you're thankful for us, give us a thumbs up thanking us. But email jimwelshmacro@gmail.com just to get your most recent macro tides and tell them you saw us on our show. That'd be great.
Yep. That'd be great. All right. Take care.
You guys have a great one. Thanks, Jim. And I'll see you in 2 weeks. Hey, traders. Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.